Good morning, good afternoon, good evening, depending on which part of the world you're at. This is the CBDC broadcast number 26. Today we're going to have Modernizing Financial Markets with Wholesale CBDC, a closer look at the World Economic Forum report. We're going to start in a couple of minutes or a couple of seconds. Meanwhile, let's people get comfortable, and we're going to start in about 30 seconds. Thank you. So let's start. So once again, thank you for joining us. This is the 26th version or episode of our CBDC broadcast. Today, we're going to have Modernizing Financial Markets with Wholesale CBDC, a closer look at the World Economic Forum report. As usual, I'm going to do some housekeeping in the first 5 minutes. Afterwards, we're going to have something like 45 minutes of the main session with our guest co-speakers, Cameron Nili from Accenture and World Economic Forum, and with Sandra Waliczek from the World Economic Forum. As usual, the last 15 to 10 minutes, we're going to have Q&As from the public. Please remind to send those questions through the Q&A widget or app that you will find at the bottom right of your screen. So, as I already mentioned, I'm going to allow Cameron and Sandra to introduce themselves. No one better to introduce yourself than yourself. So Cameron is Digital Assets Strategy Director at Accenture, and he's also a research fellow at the World Economic Forum. And Sandra is the lead of blockchain and digital assets at the World Economic Forum. So thank you very much, Sandra and Cameron, for joining us today. If you want to give a brief introduction of yourselves and what you're doing in the in the wholesale CBDC space, that would be much appreciated. Also, if you want to include any disclaimer that you feel comfortable to mention, this is the moment. Thank you both for joining us.
Yep. Thank you, Carlos. Really appreciate the warm introduction and looking forward to this discussion with Sandra and yourself. As far as myself goes, I have worked in banking and capital markets for the last 5 to 6 years. I actually originally started my career doing automation and intelligent automation work, conversational AI strategy and experience design. And I naturally found myself trying to fix some of the mid and back office challenges that many of our financial institution clients had for quite some time. But then I naturally segued from there over to the world of Web3 and digital assets, and with the intention of trying to reimagine the financial infrastructure. So as part of that, I was assigned as a research fellow with the Digital Dollar Project, which many people in your audience might know and are familiar with, for about a year, where I led a couple of initiatives focused on cross-border payments and doing a risk analysis of a possible US CBDC. So I'm based in Los Angeles, and most of my work is global, including the work that I led with Sandra here over the past 8 to 9 months on this report that we look forward to sharing with you. This particular position I had with the forum was a research fellowship where Sandra and I will get into some of the work that we just recently wrapped up, but it was focused on central bank digital currencies and financial market infrastructure. So very much looking forward to sharing some of the insights in a conversational way, Carlos, with you and your audience.
Thank you, Cam. Sandra.
Thank you, Carlos, and really a pleasure to be here. Thank you so much for inviting us to share more insights from our recent report. As Carlos mentioned, I'm a lead on the blockchain and digital assets team at the World Economic Forum. Likewise, I have a background in capital markets. And when I first got into the blockchain space, I was working at the World Bank Treasury and had the opportunity to work on a project of putting the first blockchain bond into production. So this was a bond issuance called Bondi, and it was in the Australian market. And since then, it's really accelerated, and a lot of my work has been focusing on central bank digital currency, but our portfolio at the World Economic Forum is quite broad. So it includes all different kinds of digital currency, as well as looking at the existing financial system and how we can use distributed ledger technology to improve it. So really looking forward to speaking with you all today, and thank you again for having us.
Good. Thank you very much, Sandra and Cam. So we're going to start, and perhaps I will do a very brief introduction. What we're going to discuss, as we have already mentioned, is the Modernizing Financial Markets with Wholesale CBDC report, which was recently published by the World Economic Forum. Perhaps we can share the link to the report on the chat of the WebEx, so that if someone doesn't know it, still, you will be able to check it and to read it. It's a very nice document. I have read it several times because I was fortunate enough to be invited to read some parts of it and to contribute to it. So at the end, I think this is and just to introduce the conversation, I would say that this is one of those reports which is a very much needed report, because it gives a lot of flavor, a lot of content, a lot of concepts and clarity to many things about wholesale CBDC that normally are like very fuzzy and that have no proper, let's say, background and no proper definitions. So that helps a lot to the industry to get a closer look at what is happening in the wholesale CBDC space. So the idea that we have today by inviting Sandra and Cam is to get a closer look at this report and to the main findings and to some interesting findings that have been reported and that had not perhaps been reported enough into the final version of the report. So let's start with that. So let's go with the first question that we have, and this is for Sandra, which is, what were the general objectives and scope of the report?
Thank you, Carlos. And thank you for the kind words about the report. And of course, appreciate you engaging with us and contributing to it as well. Just to set the scene a little bit and provide a bit of background as to why we decided to pursue this topic. At the World Economic Forum, we're the Organization for Public-Private Cooperation, and therefore all of our initiatives and projects that we worked on are based on our community input, and the initiatives are on topics that require multi-stakeholder engagement. And we at the forum have a large body of work on central bank digital currency, but in particular, we noticed a gap that's focused specifically on wholesale markets. When we brought this to the attention of our community, the question that they wanted to get answered was, what is the differentiated value that wholesale CBDC can play in financial markets? Many of the existing organizations that operate in the FMI today felt that maybe there's incremental changes that could be made to the existing FMI rather than the implementation of wholesale CBDC. So we came in with a research question of what is truly the role that wholesale CBDC can play that is above and beyond our existing financial system. We had the pleasure of collaborating with Accenture and exploring this research question for over 9 to 10 months. When we started the research project, we looked at a problem-based approach and looked at the existing challenges in the financial system. And when looking at those, we tried to analyze where in particular wholesale CBDC could play a positive role and add value. And the way that we did this is we convened a community of about 100 experts, and this includes some steering committee members that guided this work, and these 100 experts that advised us and provided input throughout the project. And these experts represented about over 60 organizations across central banks, commercial banks, FMIs, academics, really a whole gamut of experts that we included in this work. And we're really excited to share the findings with you today after the report was published on April 16th.
Thank you for that, Sandra. And I would like to highlight that the real value of this report obviously is about the gathering all those experts and all that people to get their insights and impressions about the wholesale CBDC, what it's today and what will become tomorrow, may become tomorrow. So let's start with the more, let's say, profound questions right now. So perhaps one contribution of the report is bringing some definitional clarity and some concepts and some background to something which is sometimes a little bit fuzzy, which is wholesale CBDC and tokenized central bank money. What are the precise taxonomies and concepts that were distinguished in the report?
Yeah, this was one of the most interesting aspects of this research, was that we spoke with, as Sandra mentioned, over 100 experts, and one of the common questions that people had for us was, what was the definition of wholesale CBDC? And I think that kind of encapsulates the general status, I would say, of the space right now. Things are moving really quickly. There are different ways that things are being done across jurisdictions, whether it's because of some policy reason or a technological reason. So often we found in our research, in the desk research that we did of over 200 reports from central banks, the BIS, other authoritative sources, that there were varying definitions. There were very limited authoritative definitions that were offered for some of these common terms that we would use, including wholesale CBDC. And so I guess one of the biggest contributions that we were able to provide, that we think that we've gotten feedback on this report, is we've been able to clarify the role of central bank money as it relates to all of these other emerging payment instruments. So as Sandra mentioned, one of our goals was to really unpack the differentiated value that wholesale CBDC or central bank issued money in general would have against some of these other emerging instruments. And if you think of stable fiat-backed stablecoins, deposit tokens, and we also introduced reserve-backed digital currency, which is central bank reserve-backed, very much akin to the solution that Finality is offering to, I think, in the UK right now, and they're seeking to expand to other jurisdictions. So we really tried to clarify that central bank money is the most risk-free, credit risk-free settlement media that can be achieved for wholesale financial markets, which includes interbank payments and securities transactions. I think the key contribution, I guess, in the report, if those who are listening are interested, there's a table that we had provided which describes the digital money continuum. And that digital money continuum makes this distinction between public money and private money, and then breaks out the different types of instruments that are relevant for the digital context. And of course, we had CBDC on the far left being the most credit risk-free. So I think that was the biggest definition, or the biggest contribution that we had. And on top of that, I think I want to make an important note that there was this notion of reserves-backed digital currency. And we wrangled with this for quite some time because it was previously called a synthetic CBDC. And we had worked with our community to really try to unpack what is the risk profile associated with it in the first place? What is it? What do we call it? And we landed on that it is not central bank money. It should not be confused for central bank money. It is not issued by the central bank. And it has a variety of criteria that differentiate it from the safety and soundness that central bank money has. Now, that's not to say it doesn't have a role in the future. In fact, one of our conclusions was that all of these instruments have a role to play in the future, but we really wanted to make sure that the reader and the audience were very clear on the differences between money. And that goes from, again, the public and private money lenses.
Good. So going to the next question, one of the other findings which is very interesting to the community, I guess, is that to find that most or like there is some consensus that the wholesale CBDC is not intended to replace but to complement existing financial infrastructure. What are some potential benefits and challenges that could come from the coexistence of the RTGS, I mean, the existing large value payment system architecture or scheme, and wholesale CBDC based systems?
Thank you, Carlos. And it was really an interesting finding from our research, because most jurisdictions at this point do include a real-time gross settlement system. Over 120 jurisdictions, and in advanced economies, it's over 90%. And so when we came into this project, there was maybe a concern that wholesale CBDC would be an end-to-end solution. It's replacing other legacy infrastructures or something like that. And that was a big concern. But I think a finding that we had was that it will in fact complement and be likely deployed in parallel in jurisdictions that choose to deploy wholesale CBDC. And when we did our research and found the areas that wholesale CBDC could improve, those being the disparate settlement cycles, the operational risk and settlement failures, the FX settlement risk, and wholesale CBDC being able to serve as a settlement tool for tokenized instruments. After finding this, we realized that those countries that do choose to deploy wholesale CBDC will benefit from deploying it in parallel, because it's going to minimize disruption to the existing financial system. As currency and money is systemic, I think that most central banks will find comfort from the fact that it will minimize disruption. It will also likely accelerate the adoption curve for integrating wholesale CBDC and allow central banks in the financial system to adjust over time and ensure that the wholesale CBDC is meeting their expectations for the added value that it can provide. But there likely will be challenges also to deploying it alongside, which will likely be liquidity fragmentation. If we have two different systems side by side, the RTGS systems and the wholesale CBDC, that's something that needs to be looked at, and we need to figure out exactly how that will work together.
Yeah, and I guess, Carlos, with respect to when and how these systems would be deployed, we already see a couple of them deployed already, like specifically the limited phase pilot within Switzerland by the Swiss National Bank for Project Helvetia. Enbridge is another great example of prototype in deployment with real transactions. So I think there are already, these are emerging, and the obvious, I think, observation that we had was that this is a domain that benefits from safety, soundness, and stability. So one of the things we want to make sure is that this wholesale CBDC notion or capability would never be viewed as a rip and replace. That's never, I think, going to be acceptable, at least in possibly our lifetimes. But possibly in the very distant future, that would be the case, where it eventually does consume more transaction volume than the existing legacy infrastructure. But for now, I think the key thing that our report actually helps to highlight for policymakers and private sector leaders are that these wholesale CBDC systems, we should be viewing them as largely a settlement infrastructure for specialized use cases. So we did try to highlight, at least in the near term, right, where we have some of the biggest areas of value to achieve, which Sandra mentioned around enabling PVP and expanding PVP arrangements for foreign exchange markets, being able to settle natively tokenized securities DVP, being able to offer a 24/7 accessibility to central bank money to break down some settlement window of friction that we have around the world, and to help essentially reduce counterparty risk when it comes to trading across borders or payments across borders. And lastly, we felt that a tokenized wholesale CBDC capability would help to mutualize data across parties, especially in the securities transactions world, because there's a lot of information that we found around the propensity for settlement failures due to data quality issues. So we felt like there was an opportunity to optimize those areas. So as an example, we don't see it being a rip and replace. It's not going to replace things overnight, but it will be used, and I think it already is being used, to achieve specialized and novel use cases. That's where it will really thrive. And the RTGS infrastructure, as Sandra mentioned, will continue to be the primary liquidity storage mechanism, we believe, for the time being, for a long time, actually. And if you look at the Bank of England, RTGS's renewal program, they are doing some fantastic work in terms of modernizing the RTGS system, chaps, to be able to meet the growing needs of the UK financial sector. So there are, in our report, we highlighted a number of RTGS renewal programs that are doing very amazing work, and they're truly bleeding edge in our view. So that's another area that we felt like we wanted to be realistic in our findings, that is a real thing that will continue to persist. These wholesale CBDC systems will largely be focused on specialized use cases and trying to unlock new areas of value.
That's great. Just to confirm a little bit what was reported in the final version of the report is using FNA clients and potential clients as a barometer. Several central banks are right now trying to assess how an RTGS and a wholesale CBDC would work in tandem. I mean, what are the challenges? What is the liquidity going to, I mean, how is it going to be the liquidity managed? It's going to be a single pool of liquidity. It's going to be fragmented. It's going to be like an API which connects the wholesale CBDC to the RTGS and use the money, tokenize the money like with an API. And so this kind of modeling is something that tells you that central banks are thinking that coexistence is the way, at least now, but that they are eager to model how different migration scenarios could affect liquidity in the system. Also, for instance, something that is very interesting is, are central banks going to grant access to intraday liquidity facilities to new entrants to the wholesale CBDC? What I mean is non-banks financial institutions entering into the wholesale CBDC system. Those are questions that are around right now, and you need some simulation and some modeling to do that. And going to the next question is very related to what I just mentioned, which is, what are the challenges that could persist or even increase if they're left unchecked regarding what could cause the wholesale CBDC in terms of liquidity management? What are the challenges and the more most likely solutions to these challenges of entering a wholesale CBDC into the picture of the wholesale liquidity market?
Yeah, this was one of the fun ones to cover in our research, because there was, as you know, Carlos, but maybe your audience doesn't know, we covered 8 different areas of challenges that we identified as they relate to the wholesale financial markets. And as Sandra mentioned, we took a problem-led approach. So we wanted to really understand the business problem as it relates to the use cases of wholesale CBDC. So as part of that business problem analysis, one of the areas that we determined was going to be a persistent challenge for the industry is around liquidity management. We felt like this was still a very unanswered question, I guess, from the perspective of, will a wholesale CBDC be able to address this challenge or not? And Carlos, you know better than me. You were one of the lead authors on this section of the paper, but liquidity risk has been a challenge for decades that we've been dealing with, at least with modern electronic payment systems. It's always been a challenge. And as you know, it's a sticky subject, and we originally had deferred net settlement systems that did a fantastic job of mitigating liquidity risk, but they were highly inefficient in many ways. And then we gradually shifted to RTGS systems to be able to treat transactions on a transaction by transaction basis, which was excellent in terms of liquidity risk. But it eventually, it was excellent in terms of counterparty risk, because every transaction was treated separately. but then it increased liquidity risk because pre-funding was then a higher demand to be able to complete transactions on a transaction by transaction basis. So now we're now on the dawn of a new type of system, which would be wholesale CBDC. So we've went from net settlement systems to gross settlement systems. And in our paper, we articulate these differences all the way through to now instant and atomic settlement systems, which are capable of instantly settling payments within seconds. However, we do make this distinction that just because a system is capable of doing that doesn't mean that it needs to do that for every trading scenario. And this was one of the excellent contributions that you had, Carlos, you and your team from FNA, was that we need to think about trading scenarios and the different liquidity risk profiles against each of those. It may not be necessary for us to instantly settle across all trading scenarios. In fact, some trading scenarios, like for example with the FX markets, they benefit from a T+2 cycle, right? They do. So they're able to offset obligations between multiple parties. And generally speaking, in FX markets, you're able to predict your demand for currencies quite well. So in that case, there's some room for, there's some wiggle room to mitigate liquidity risk. But as we look at the wholesale CBDC systems, I think the key finding that we had was it's going to be a persistent challenge to manage liquidity risk. There's no one-size-fits-all solution. But there are two schools of thought that we've come across. The first school of thought is around atomic settlement will allow parties to never be short liquidity. So what that means is they would be able to exchange whether it's a currency for an asset or a currency for another currency of equal value, and therefore they would never be short liquidity. So in theory, they would always maintain their existing level of liquidity in a trading scenario, right? So this is one school of thought. The other school of thought is what I mentioned earlier, is just because we have this instant settlement capability that suddenly every trading scenario would result in an instant trade. That could be true in some cases. It depends how people want to design it. But we believe that there needs to be settlement variability so that parties can be able to adjust what are the settlement windows that are applicable for that particular trading scenario. But if that isn't available, then of course, if left unchecked, an instant settlement scenario would then result in increased speed, but also increased liquidity risk because there's going to be an increased need for pre-funding to settle all of those trades. So we think, all of this is connected. And in fact, our paper, I think, came at a very good time because this is the time to start thinking about how we introduce settlement variability in these systems and do it better than we've done it before. Because we've learned from the DNS world, the deferred net settlement world, how effective offsetting can be between multiple parties. And then we also learned from a gross settlement standpoint, how we can essentially mitigate and completely eliminate counterparty risk. We've also, I didn't mention, but we have liquidity saving mechanisms that are also bolted on to our RTGS infrastructure that help banks to optimize their liquidity. So we've learned a lot, but now it's up to us to embed this into the future M0 settlement infrastructure.
Thank you, Cam. It comes as no surprise that at FNA we are like we belong to the second school of thought, that we think that synchronization of payments is not to generate automatically or it's not to be taken for granted. So I think that there is a lot of space for research and for testing how the atomic settlement could demand more liquidity, because at the end, atomic settlement, RTGS systems, if they're like 100% RTGS with no queues, with no delays, outright rejection, that's exactly the same as atomic settlement. And you can test many payment systems that work on that could work on 100% RTGS, pure RTGS, that liquidity demands increase. And we could also mention something that we have mentioned in previous episodes of the CBDC broadcast that have to do with wholesale CBDC, that some pilots, the banks themselves, have reported that their liquidity needs increased because of atomic settlement. So I think that and that's my humble opinion, is that the second school of thought has a little bit more background about what would happen if everything is tried to be settled immediately. So, but the research and time will tell. Going to the next question, we're going to talk about interoperability between wholesale CBDC platform and the legacy system, which is obviously flagged in the report as a major hurdle. It's something which would be very difficult to attain. From a technical, operational, governance perspective, what do you think are the key barriers to cross-system integration?
Thank you for this question. I think this one is really key for a lot of the experts working in CBDC. Interoperability is top of mind for them. Before working on this report, I actually spent a year working on a report on CBDC interoperability, and I can say there are a lot of challenges and many areas that still need to be resolved for interoperability, because it's not only interoperability with the existing legacy systems, but it's also interoperability with other payment modalities, like the ones Cam mentioned, the reserve-backed digital currency or fiat-backed stablecoins, or deposit tokens. All of this will likely interoperate in the future. And so we need to look at interoperability from a governance perspective, legal perspective, technical. There's really so many elements of this question. And when we were looking at the report, as Cam mentioned, liquidity was one of the challenges that we highlighted. Two of the other challenges were focused on interoperability. So that being kind of from the governance and regulatory perspective, and then the other being from the technical perspective. And when you look at some of the BIS reports, they've also highlighted some of the different interoperability models that we might be able to work with. One being the compatibility model, where we will have a common standard and organizations could adhere to this standard for interoperability purposes. The other model is the interlinking model, where there will be a organization that's supranational that organizations will be able to plug into. And the last being the single system model, where organizations can all adhere to a single system. And an example of this one is the Enbridge project, which does advocate and test the single system model. And when we look from a legal perspective for wholesale CBDC, it's actually quite positive that 85% of central banks have laws that allow for issuance of wholesale CBDC, but some countries don't, and this is something that we'll need to look at when it comes to interoperability, is for cross-border payments, looking at the legality and the regulatory concerns for implementing wholesale CBDC. When it comes to technical interoperability, there are also some challenges here that need to be thought through. So we've been speaking a lot about the existing RTGS systems, and Cam mentioned some of the renewal programs that are happening that are trying to integrate distributed ledger technology. Many of the wholesale CBDC models are also DLT based, although that's not a requirement. But the Eurosystem has been looking at some technical interoperability solutions for DLT in these systems. So one being the trigger solution, which is being explored by the Deutsche Bundesbank, and that one is using the existing RTGS system and just integrating a DLT layer. The next solution that's being looked at is from Banca d'Italia, and they're looking at an API integration for DLT, but the API itself is DLT agnostic. And the Banque de France is looking at a full DLT solution for interoperability and engaging DLT within the existing systems. So I think all of this is to say that there's still a lot of exploration and experimentation going on, because this is such a challenge and it's a key concern for every jurisdiction that would like to implement wholesale CBDC. And I think the takeaway here is that any changes will require both public and private sector collaboration, as well as global cooperation, because many of these interoperability challenges will be happening across borders.
Thank you, Sandra. So the next question has to do a little bit with the interoperability in some sense, and it's about what did you find about the expected relationship with other old and new forms of money? For instance, with reserves, which we already talked about that a little bit ago, but also the new ones, which like deposit tokens, stable coins, and retail CBDC. What could be the relationship between the wholesale CBDC and these other new forms of money?
Yeah, so one of our great question, and actually like a big crux of our research, was to figure out, what is the path forward for something like a wholesale CBDC, right? And it wasn't with the intention of, coming in with the answer that the answer is yes, we need it, but it was how would this exist in the future amongst the herd, right? Amongst many other alternatives that early on in our research, we were being kind of peppered with in terms of questions from our experts around, like, for example, like finality solution. I'll pick on them because that's likely that's the most successful of the RBDC implementation, the reserves-backed digital currency concept. But we were getting questions as to why do we need wholesale CBDC? RTGS systems are digital already. They're digitized payment platforms. RBDC systems like Finality, they offer similar outcome as wholesale CBDC systems do. But really what we landed on was, and this goes back to what I was mentioning earlier around the education of the digital money continuum, but central bank issued money holds a very special place in financial markets. It does provides a very special service, I will say. It is credit risk free, as I mentioned, with the exception of sovereign credit risk, which would be like a central bank going default, which has happened, but is extremely rare if you look at some of the largest CLS applicable currencies. But really what this does, and what our overall takeaway is that wasn't necessarily documented in the report this way, but the world is moving in this direction. Things are becoming increasingly digitized. Private markets are realizing and embracing the power of tokenization as it relates to their operating model, their customer experience. And so things are moving this way. And we highlighted the SIX Digital Exchange as a leading example of embracing tokenization as it relates to securities for their customers in Switzerland. So if the world is moving this way, and we have increasingly more and more securities being tokenized, more retail, I would say, tokenized payment instruments, such as what Sandra mentioned, like a deposit token, fiat-backed stablecoin, and other emerging tokenized payment instruments, variations of stablecoins, then what we need on the back end is a M0 settlement instrument that works alongside those various tokenized instruments natively, right? I think what basically doing now as the financial sector is trying to embrace and manage a multitude of trends that are ultimately converging, I think, on tokenization, we're having our legacy infrastructure trying to keep up with the speed and pace of the tokenized payment instruments at the retail and commercial levels. So we think that there's this opportunity for us to get up to speed with how fast those are moving by introducing a real tokenized M0 settlement instrument that can provide that settlement layer for all of these emerging payments, assets that I mentioned earlier, so that they can work safely. I think the most important thing, Carlos, from our perspective, is that if we don't do this, it could introduce risk down the line, right? If we don't have CBDC that's tokenized that can settle at the M0 level at the speed that some of these other instruments are moving, we then create this risk aperture, right? There could be more risk that could be introduced because you wouldn't be able to natively settle on the back end central bank money as it relates to commercial bank money and assets. So as far as the distinct relationship, I hope that gives an overview, but in general, I think RBDC systems will continue to expand. I think they've found their use cases in terms of securities transactions, as well as to hopefully get to a point where cross-border payments can be optimized. There are some risks that I mentioned, but we have those documented in our report for your audience to read through. As far as deposit tokens and stablecoins go, we intentionally segmented this out to the retail layer because those are not applicable for the use cases that we were looking at for wholesale CBDC, which are interbank payments and securities transactions. But the big difference between these two, which we get into in our report, is deposit tokens operate within the KYC boundaries of the issuing banks, right? Whether it's the issuing bank or a partner bank that token can circulate between, but it's a KYC boundary, right? So the banks know who's using it and they are permitted to use it and they are not criminals, basically. On the fiat-backed stablecoin side, this is generally very hard to manage because, as you know, in the Web3 world, you really only know KYC at the redeemer and the issuer levels of that stablecoin, right? So once it goes past that individual or that wallet or that user, it suddenly becomes very opaque who's using it and for what reason. And of course, there's a lot of individuals that are working on this in terms of helping to unpack some of the analysis that's required at the transaction level to figure out who's using what. But generally speaking, from the BIS standpoint, and also from our standpoint, there is a KYC boundary that the deposit tokens benefit from. Now, I won't get into the advantages and risks of, or the advantages of fiat-backed stablecoins, but I think they do have a role to play as well. And then also, we've articulated this in our conclusion as a multi-token and multi-system future, where all of these instruments that I mentioned have a role to play. Now it's just up to us in each jurisdiction to impose policies to be able to put the guardrails on how we use them and where.
And I just wanted to add as well that we think this is a particularly unique feature of the report that we included all of these. Just because typically most reports focus on CBDC specifically, and sometimes it's hard to understand how these different payment modalities operate within the same system. So this is kind of why we took the time to make sure to include them, even though they do have particular roles and use cases that are slightly different from each other.
And that's great. I think that, and I agree with you both, that a good contribution, a very nice contribution of the report is highlighting that wholesale CBDC is not going to exist alone. It's going to coexist with many things. And one of the things that perhaps I would like to highlight from Cam's answer is the need to have a form of central bank money in which financial market infrastructures, the traditional ones and the new ones that perhaps we haven't seen them created yet, that they should be able to settle their transactions in central bank money, because that's part, like the PFMI, the Principle for Financial Market Infrastructures, advice on how to reduce the risk in financial market infrastructures. So that's a key point of having a wholesale CBDC. It's not going to replace the RTGS system. It's not going to necessarily to replace the other forms of money, depositing tokens, stablecoins, or retail CBDC, but it has a space to fill. Otherwise, there will be a void in this sense. So, and going to the next one, and that's a topic that I found very interesting because I haven't thought about that much, which is accessibility implications for wholesale CBDC systems. What are the potential accessibility concerns and inequities that may require mitigation by central banks?
Yeah, this one is, Sandra knows, one of my favorite topics, but I think it's actually it's not talked about enough, is my conclusion on this particular domain. I think as I mentioned, we've come from a long history, DNS to RTGS. Now we're on the precipice of wholesale CBDC as the wholesale settlement layer. One of the biggest value propositions at wholesale CBDC, and oftentimes what's included in a discussion is DLT, is that we can be more creative about how we grant access to these systems, right? That's generally that's the headline. But then what does that mean? is actually super important and also will be the make or break story, I think, of the future of this stuff. So in the current world, as far as RTGS systems go and wholesale settlement platforms, it's quite limited, as you know, Carlos. There's very limited financial institutions that are granted access to even look at the system, right? To be able to access it and look at it. Let alone those individuals that are allowed to lend on top of their reserves. So there's even like a tighter group of institutions that are allowed to extend loans on the reserves that they have with the central bank. So I think those are already two types of access levels that could be granted. One is simply access to central bank reserve to use it for payments. And we've already seen this go beyond banks in the UK jurisdiction. I think in 2018, we highlighted that TransferWise, and now called Wise, is a non-bank PSP that was granted access to central bank reserves. So they can use that to make direct payments with their counterparties, and it's not based on any credit. So it's pure cash that's being transacted. So that's one type of access, is you can use the cash in your reserves account to make payments. The second type of access level, which is very common today, obviously these two are very common, are that you can access your central bank reserves and have monetary lending capacity on top of it. So you can issue loans to your customers. There are risks and controls that are in place, risk management protocols that are in place to protect the financial system so that that bank really understands the level of risk they're allowed to take on in terms of credit risk. So those are the two predominant types that we saw today. And of course, I'm generalizing and simplifying. But the third area where I feel there's not enough attention as far as we look forward is the type of access that doesn't require touching the liquidity at all. So there's no touching of the cash in those reserves. And this type of access level would be like a service provider that would provide services, for example, like a settlement service where they would connect two counterparties to make a trade, or they would be an interoperability service provider, which, as Sandra mentioned, is going to be a key crux of all of this, is who is going to facilitate interoperability between different networks. So there could be a service provider that simply has access to that system to be able to create that handshake between counterparties, between networks, et cetera. So I think in general, as I've described those three types of applicable access levels, one of the biggest questions moving forward is that we need to think about who can gain access to the system in the future, because right now it's quite limited, and there's a reason for that, right? This is because it's a safety and soundness exercise, as I mentioned earlier. But with the advent of DLT and being able to create permissioning structures that are creative, unique, and can be flexible, I think we need to rethink about who we grant access to and how we control their access, right? So that we can further diversify and expand financial inclusion for a number of different providers, including stablecoin issuers. I mean, that's one of their key policy objectives, is to gain access to central bank reserves so that they can back their token with central bank money, which, as I said, is the most credit risk-free asset in the world. So,
good. So let's go to the final questions because we're running a little bit late. Anyway, we started 5 minutes late, so we're going to take that 5 minutes back. So we're still right on track. So I'm going to skip one question, but we're going to go to the potential wholesale CBDC rollouts. According to what you or what was found in the report, what are the most crucial risks or obstacles for policymakers in the rollout of wholesale CBDCs?
So the way that I would answer this question is, if we're looking at policymakers, I think what is important right now is more education and awareness building. And that's part of the reason why we wrote this report, is to provide a foundational resource that looks at the existing problems within the financial system and how wholesale CBDC could solve them. I think the challenges and obstacles that policymakers will face will be different in every jurisdiction. As a result, the way that we wrote the report is supposed to serve as a resource for different countries in different ways. When we look at advanced economies, many of them have real-time gross settlement systems. So there's specific challenges that will be related to that we spoke about earlier in the day about integration and interoperability, et cetera. However, in some emerging economies, maybe they don't have existing RTGS systems, so their risks and challenges are going to be different than for some of the advanced economies, and their considerations for implementing a wholesale CBDC will likely have different choices. And so as a result, I think that we in this report are trying to provide a lot of information for every jurisdiction to make the right choice for their financial system.
Yeah, and Carlos, just to add a little bit onto that, because I know we got to get to the Q&A, but this is a very delicate subject matter generally, this entire topic, right? CBDC, national payment infrastructures. This is really like a sovereignty topic, right? Every jurisdiction has their national payment systems that they want to manage, introduce, optimize. It really is a national security type-esque exercise, really, if you think about it. I mean, in some of the central banks that we spoke with, some of their primary motivations are around ensuring that they are persistently competitive with their neighbors, right? And I won't mention specific ones, but this is, a very, I don't think, talked about enough. That's one of the main observations that I had, and this is my personal view. But as far as that goes, I think the biggest challenge and obstacle that we will have is a human challenge. I think the technological stuff can be figured out. Interoperability from a technical standpoint can be figured out. But the challenge will be creating coordination and aligning coordination across jurisdictions to break down these barriers that we're dealing with today as far as inefficiencies go. So that will require, like Sandra mentioned, public-private sector coordination and ultimately agreements on new standards. For example, ISO is introducing new standards all the time. SWIFT is introducing many great new standards. So I think we need to work together, and that's, I think human challenges will likely be the biggest obstacle, is my personal view.
Coordination is always the biggest obstacle. So thank you, Cameron and Sandra, for answering the question that we have prepared for today's broadcast. Now we're going to the final question, and I hope you can make it very quick, which is, what were unexpected findings that you had in the report and that are worth mentioning here, and that perhaps were not mentioned a lot in the report?
I think, we mentioned this a little bit already, so I already previewed it, but generally speaking, the world is moving in this direction. And when we were starting this research, I don't think we really understood the level of momentum that was already in place. And in some ways, the horses are, I forget the expression, but they're off to the races, right? It's already, the train has left the station, I think is a better analogy, but the train has left the station. The industry is moving in this direction, and the policymakers are quickly taking note. And, of course, we haven't talked about some of the, other digital crypto assets in the world, but there are alternatives being introduced on a daily basis almost. So I think central banks, policymakers are recognizing this. And as I mentioned, to preserve the soundness and stability of financial markets in the future, we need commensurate M0 settlement media, which in this case will be central bank digital currency. So that's, I was not that highly convicted before, but after this research, I really believe that we need it in order to preserve the soundness and stability of the system.
And I would just add, it's something that we've talked about throughout the call, but the parallel implementation of wholesale CBDC is something that I just found most surprising. I think when we started out this research, I was a little bit worried that different stakeholders were going to have very strong opinions and not be willing to cooperate and work together on this topic. But it became really clear that every institution and organization has a specific role to play, and that the different payment modalities will work together. And so there's very much not a winner takes all mentality when doing this research. It was very much kind of trying to find how all of these can work together.
That's great. Sandra, Cam, thank you very much for helping us today with these questions about and insights about the report. Now I'm going to turn very quickly to the Q&As to the Qs from the public. Perhaps the most interesting that I have found here has to do with what about the monetary policy transmission and seigniorage impact of wholesale CBDCs? Is that something that is assessed in the report, or that you have some insight about it?
So the monetary policy transmission topic was one that we discussed with several experts. I think the main finding that we had was with the introduction of a new central bank issued money, that would ultimately impact the ability for a central bank to apply QE or QT, quantitative easing or quantitative tightening. There is very specific and much people that are much more in the weeds on this, but there are tiers that are related to interest rates, and wholesale CBDC would ultimately impact those tiers and how they are distributed to the financial sector. So as far as our research goes, there wasn't much that we covered as far as a conclusive finding on this topic, but yeah. So Sandra, I don't know if you have any comments to share.
Sure. I would just add that this was a key topic that we researched during this report, but ultimately decided not to include as a topic within the publication, just because of several of the topics we highlighted are requiring a lot more research and experimentation, but this one in particular, there's just so many different opinions. And we worked a lot with the IMF and with several economists, and thought that they are best placed to provide an authoritative answer on that question.
Good. We're going to have the last one, and this is a very interesting one. Do you think that RTGS systems could ever be upgraded enough to accommodate the trading and settlement of tokenized securities? And I would add, to be able to avoid going into wholesale CBDCs?
I think this was a big focus for us. We wanted to understand this question very strategically. In general, there are a few limitations that we observed. One is that RTGS systems are inherently, they were built decades ago, they're being modernized, but in some cases, they don't have an ability to run 24/7. So that is one key limitation that some of these systems have. And in our report, we highlighted the 5 jurisdictions where there is near 24/7 accessibility of those systems. And while that doesn't really matter for a domestic use case, it does matter for a cross-border use case, especially for large financial centers. So I think that's one area where I think is a limitation. The second limitation I view with RTGS systems is that they're inherently not tokenized cash. They're not able to be accepted across or outside of the system. And therefore, for example, we discussed 6 digital exchanges set up in Switzerland. The private sector has to come up with essentially middleware that they're able to settle their tokenized securities on their platform with then additional handshakes or integrations required to RTGS systems to then ultimately settle with the central bank or with their counterparty. So I think in those ways, they're limited. Not to say that they can never be modernized to a point where they're able to fully be on par with what we believe a wholesale CBDC can do. And as Sandra mentioned, there are multiple integration models that the EU is exploring as far as, for example, Banque de France's full interoperability solution, the Banca Italia solution, as well as the Deutsche Bundesbank solution. So there are efforts underway to figure out how we can create the necessary handshake to reach the same levels of performance that a wholesale CBDC would do. But so far, those are very experimental, and we haven't seen any conclusive evidence of such.
I would just add that, as Cam mentioned, these RTGS system renewals are ongoing, and right now, I don't think we've seen proven experimentation that shows that that's that will likely be the case, that we can just upgrade our TGS systems to not need wholesale CBDC. But it's quite possible as we move along to see what experimentation comes through. I think the reason I'm skeptical is just because retrofitting any existing system, I think, might be harder, more time consuming, and more costly than maybe just adding a new system that is unencumbered by the existing challenges.
That's great. Sandra, Cam, thank you very much for joining us today. This is the end of the CBDC broadcast number 26. Upcoming events, just to mention, for the month of June, we're going to have the payment system broadcast number 16, which we're going to talk about regulated liability network. Also, we're going to have the CBDC broadcast number 27, in which we're going to talk about Project Polaris. And we're also going to have Treasury broadcast number 3. So thank you very much, Cam, Sandra, once again. Thank you, everyone, for joining us today, and see you very soon. Have a nice day, all of you.
Thank you, Carlos.
Thank you.
Thanks, everyone.